Right, let's talk about becoming a landlord. Right, so I know the word landlord carries a lot of baggage these days. There's tax changes, there's rule changes, there's the odd headline that makes the whole thing sound about as appealing as a tax return on Christmas morning. And yet, here in the East Midlands and right across the country, people are still buying property to let, quietly, sensibly building something for later. So this is the complete journey, start to finish. Whether you're buying your first rental or you're a portfolio landlord adding number 15 to the collection, or you've just inherited a place and you're wondering whether to sell it or let it, I'll walk you through the whole thing, warts and all. So here's the honest version up front. Buy to let is far from being a get rich quick scheme. Anyone who tells you that is probably trying to sell you a course. It's a long game, it's bricks and mortar, tenants, a bit of admin, and a mortgage that works a little differently to the one in your own home. Get the setup right at the start though, and it can be one of the steadier things you've ever done with your money. So go grab a cuppa and let's go through it properly. Right, so before we even touch rates or deposit, there's a fork in the road and it's one that trips most people up. Do you buy the property in your own personal name or through a limited company? Now, I'm going to say something really important here, and I'll probably say it more than once because it matters. I'm a mortgage and protection advisor, not an accountant. The which is better question is a tax question first and a mortgage question second. So the right order to things is talk to a good accountant about the tax side and then come back to me to arrange the lending. We work as a team on this one. But here's the lay of the land so the accountant conversation makes sense when you finally get round to it. If you buy in your personal name, the rental income gets added to your other income and you're taxed on it. For higher earners, that can sting. There used to be a lovely arrangement where you could offset your mortgage interest against the rent before tax. That's been phased out for individuals, replaced with a more limited tax credit. This is exactly why so many landlords now look at the limited company route. A limited company, often a special purpose vehicle or SPV, is a company set up just to hold property. The rent goes into the company pays corporation tax, and the way mortgage interest is treated inside a company is different again. For some people, that's more efficient, especially if they're higher rate taxpayers or building a portfolio. For others, with the extra accountancy costs and admin, it simply isn't worth it. There's no universal right answer here. There's only the right answer for you. Anyone that gives you a blanket always use a company without looking at your numbers first is frankly guessing. But one quick practical note for the company route, lenders like to see the company's standard industrial classification code, its SIC code, set up properly. Things like property management, investment or development, brand new SPVs with no trading history are absolutely fine. Lenders see them every single day, so don't panic if you only just set one up and it's emptier than the Marie Celeste. So on to the money, and this is where buy-to-let really parts company with normal residential mortgages. First of all, the deposit. On a residential mortgage, you might get away with 5 or 10% down. On buy-to-let, lenders typically want more skin in the game. 25% deposit is the common starting point, so you're borrowing around 75% of the property value. Some products do go a little higher in deposit for certain property types, and the bigger your deposit, generally the better rates you're going to see. Secondly, and this is a big one, the rental stress test. When you apply for your own home, lenders look at your salary. For a buy-to-let, they're far more interested in the rent the property's going to bring in for you. They want to know that the rent comfortably covers the mortgage, with a healthy buffer on top so that if interest rates wobble or you hit a void month, the thing still stacks up. This buffer has a name. It's called the interest coverage ratio, or ICR. And the way that it works is that the rent has to be a certain percentage over and above the mortgage payment. Now, the exact numbers vary lender to lender and by your tax position, so treat what I'm about to say as a typical shape rather than a quote. For a basic rate taxpayer or a limited company, lenders often want the rent to cover about 125% of the mortgage interest. For a higher rate taxpayer, that requirement climbs up to around 140% because the taxman takes a bigger slice of your rent, so the lender wants more cushion. HMOs, or houses in multiple occupation, tend to be assessed a little tighter again. If your eyes just glazed over, here's a plain English version. The property doesn't just need to wash its face, it needs to wash its face, dry it, and have a bit left over for a rainy day. My job is to find the lender whose sums actually work for you, your property, and your situation, because the difference between them can be the difference between a yes and a no. So the property has to pass the rent test, but you, the borrower, have a few tick boxes that you've got to fill in as well. Lenders are going to look at your credit history, not in quite the white knuckle way they do for a residential mortgage, but it still matters. Typically, they're going to want to see no recent defaults and no county court judgments hanging around unsatisfied, and a clean run on any mortgage you already hold. The exact rules differ from lender to lender, and some are far more forgiving of a bumpy pass than others. That's genuinely where a good advisor is going to earn their keep, because we know which lenders will say no thanks and which will say tell me more. And before you apply for anything, do yourself a favour and actually look at your own credit file. Not a flattering little app score, the real thing across all 3 UK credit agencies, because the lenders don't all use the same one. I always point people towards Check My File for this. It pulls all 3 into one report. And just so you know, yes, that is an affiliate link down there. It costs you nothing extra. The link's in the video description if you want it. Knowing what the lender's about to see before they see it is one of the cheapest bits of preparation you can do. And there's a few other things in the lender's intro that we ought to talk about. They'll want proof of your deposit and where it came from. They may want to see your latest tax year figures, the SA 302 and the tax overview if you're an individual, a bank statement typically, and increasingly they're going to ask for open banking access, which just means a secure peek at your bank account so they can tick the affordability box a little bit faster. If you already own rental properties, you might be what's called a portfolio landlord, usually defined as 4 or more mortgage buy-to-lets. At that point, lenders dig into your whole portfolio, not just the property you're buying. Once it gets really large, say 20 plus properties or a few million in lending, it often goes to a specialist team. It sounds really daunting, and it isn't once someone's helped you get your portfolio schedule in order. And it's not just standard houses and flats. Lenders will consider HMOs, multi-unit freehold blocks, new builds, ex-local authority flats in the right circumstances, even holiday lets and Airbnb style properties. And there are specialist options for expats letting out a place back in the UK. Different rules for each, but the doors are open. Now this next bit, if you take one thing away from this whole video, make it this one, because it's the thing landlords keep getting blindsided by. Energy efficiency, specifically your energy performance certificate, your EPC. The government's proposed plan is that all rental properties need to reach EPC Band C by 2030. There's a cost cap and some exemptions in the proposals, so it's not quite as blunt as it sounds. But the direction of travel is clear. Lots of rental homes are sitting at a D or E right now and are going to need some serious work doing. And the stick behind these proposals is a real one. Under the same proposals, the maximum fine for breaching the minimum energy standards is set to jump up to £30,000 per property. Right now, the cap is far lower, but that's the direction they're heading in. 30 grand per property. That's not a typo. And here's the thing though, and this surprised people, there's a carrot as well as a stick, particularly in my neck of the woods. Research from the Mortgage Works, which is part of the Nationwide, in their spring 2026 report, found that more energy efficient rentals are genuinely worth more. An A or B rated property attracted around 8% rental premium compared to a similar D rated one. And across the Midlands, that price premium for an A or a B rated property over a D was running at around 14%. The North did even better. And they reckon that in the Midlands and the North, a typical landlord upgrading from a D to a C could recoup the cost within about 5 years, purely through higher rent and value. So this isn't just compliance for the sake of it. Done sensibly, the green stuff can actually pay, which, by the way, is exactly where a green mortgage can come in. Lenders are rewarding more efficient properties with better mortgage deals. So ask me about those. It's one of my favourite things to talk about, because it's that rare thing where doing the responsible thing and the profitable thing point in the same direction. I'm going to keep this chapter short, and you'll understand why in about 10 seconds time. Tax is central to buy-to-let. Stamp duty has a surcharge for additional properties. The income tax treatment differs hugely between personal name and company name, as we've already covered. There's capital gains tax to think about when you eventually sell, and the rules have a habit of changing as often as the British weather. So here's my line in the sand. I am not a tax advisor. I would be doing you a disservice if I pretended otherwise. Specific tax decisions belong with a qualified accountant, and the gov.uk website is the reliable source of the current rates and rules. What I will do is make sure that the mortgage we arrange fits whatever structure you and your accountant land on. Personal, company, portfolio, whatever shape that takes. Think of it like this. The accountant designs the engine, I make sure you've got the right fuel in it and that it actually starts. Don't try to skip the accountants to save a few quid. It's the most expensive saving you will ever make. And if you want an introduction to a good accountant, let me know. I know quite a few that I've worked with in the past. So you've got the property, the structure, the mortgage. Now let's make sure a bad day doesn't unravel all of it. And this is the bit landlords love to skip. And it's the bit you're probably going to hear me nagging you about, because I've seen what happens when this is missing. Start with the building itself. You'll need proper landlord buildings insurance, which is not the same as ordinary home insurance. And many standard policies won't cover a let property at all. There's a landlord-specific cover of things like loss of rent, property owner's liability, even malicious damage. If a pipe bursts in February and the place is uninhabitable for 3 months, that loss of rent cover is the difference between an inconvenience and a genuine hole in your finances. And then there's you. If the mortgage on your own home or lifestyle leans on that rental income, ask yourself the awkward question: what happens to it if you can't work? Or worse, even income protection, life cover, critical illness cover. And if you're holding a property in a limited company with a business partner, business protection can stop a death or serious illness turning into an ownership nightmare. Nobody fancies discovering they're suddenly in business with their late partner's relatives. I'm not here to wrap you in cotton wool or sell you things you don't need. I'm here to find the gaps, show them to you, and let you decide. That's my job. Right, so how does it actually work when you sit down with me? Let me demystify this for you. Step one, we're going to have a proper conversation, what I like to call a discovery call. This is about your goals, your situation, whether you've got an accountant in your corner yet, what you're trying to build. No charge, no pressure, just a chat. And then there's step two. I go and do some legwork, whole of market research, find the lender whose criteria and stress test is actually going to fit your property and your tax position best. And I'll also start looking at things like protection and landlord insurance alongside that for you. I can also help line up the surveys and the solicitors, so you're not juggling a dozen phone calls. Step three is we're going to finalise that application. We're going to package it properly so the underwriter's got everything first time, and we're going to get you through to a completion. On fees, you'll know exactly where you stand before we begin. Buy-to-let mortgages, my fee is £795. It's a touch more than a standard residential mortgage because there's genuinely more to it. The structures, the criteria, the portfolio side, and you'll always know the number before you commit to anything. No surprises. I hate surprises on the bill as much as you do. So that's the complete buy-to-let journey from should I even bother all the way to the keys, tenants, and the property that's properly set up and properly protected. If you've been sitting on the fence about buy-to-let or you've got a remortgage coming up on a rental in the next few months, this is the moment to have a conversation. Don't leave it until you're up against a deadline. I'm Patrick Wakeman, your local East Midlands mortgage and protection advisor, serving clients up and down the UK. Drop me a like and a follow for more and hit the links in my bio to get in touch. As always, think carefully before securing debt against your property. Your property may be repossessed if you do not keep up repayments on your mortgage. Buy-to-let mortgages and some forms of business protection are not regulated by the Financial Conduct Authority. Speak to you soon. Bye-bye.